Hi, my name is Ewan and I work for Able. So today we're going to be discussing market phases, so how the market moves and why the market does what it does. So the four phases. So here we can see the four phases on the screen. We have accumulation, markup, distribution, and markdown. We can kind of split this into two, the green and the red, so positive, negative, and also price can only move sideways, accumulation, distribution, consolidation here, or it can move up and down in these bigger moves. So this is the only two ways price can move, up or down or sideways. So accumulation refers to the phase in the market where large investors such as institutions and mutual funds or experienced traders gradually buy a significant amount of a particular asset. So that could be stocks, gold, crypto, whatever, and over time without causing a noticeable increase in the price. So it just kind of consolidates and price moves to the side. The markup phase is where the price of an asset starts to rise significantly. So we can see the price rise here. And this is where the large investors or institutions who have accumulated their positions in this phase begin to drive the price higher, triggering a broader market rally. So essentially price increases. Distribution, we can see here at the top, refers to the phase where large investors or institutions begin to sell off their positions following the markup phase. And their goal in this phase is to sell their accumulated holdings. So the stuff they bought up here, waited for it to go up to the distribution at a higher price than the other market participants, everyone else. And often the sell-off of these will result in a markdown, which we can see here, which comes after the distribution phase. And that's caused by simply the selling pressure outweighing the buying pressure in the market. So they're the four phases. Price can only consolidate, move sideways, or it can go up or down in these four phases, which we've just gone through. So an on-chart example. So it's always important to start at a higher time frame. These are the phases which are formed by the larger traders, institutions, and large investors. So they don't look at the 1 minute, and it happens over a significant period of time. So the more we understand the higher time frames, the more better and stronger we can trade on the lower. Markets are fractal, so to speak, by nature. So anything we can apply in the larger will also apply in the smaller, and we can use that to get double confirmations, etc., by allowing us to identify trends within a trend, and that allows us to get the strongest trade. So on the screen, we can see the range of data is being supplied over a period of years. We can see price accumulating here, moving sideways before it spikes up in this little markup phase. You could even argue that right here we have a little reaccumulation, which we'll get onto a second, before another markup where it spikes up. But essentially, price is moving sideways, consolidating. It sparks up. Here's the markup phase, and it gets to the peak where we can see prices distributing, consolidating, before we can see the markdown, the big drop in price where the markets begin to fall away. So always in a phase, but not always the order. So what do we mean by that? We can see a little example here. It's important to remember that not every time the market goes through the accumulation phase, it won't always follow that model that we saw previously to a T. And this applies to all phases. For example, distribution, it could mark down another distribution before, etc. So it's important to remember price can only move sideways, or it can go up or down. But as an example on the chart, we can see a phase of accumulation at the bottom where price is consolidating, going sideways, followed by another markup, price has gone up. But instead of going straight into the distribution phase and the market falling away, the market is reaccumulated. So these large investors and institutions have saw this as an opportunity where they deem the market is still too cheap for what it should be, the real value. So they're reaccumulating, investing more, and we can see another markup followed by yet another period of reaccumulation, sideways price action before finally going up into the distribution. And we can see a nice little head and shoulders sell pattern here before the price decides to sell and go down into the market markdown phase. And again, as I mentioned, it can apply on the flip side. So this markdown could have redistribution before going into another markdown, and etc. So just the model is not specific. it's loose, but the market will always has to be in those four phases, and it can only go one of two ways, right? So thank you guys for watching. Hopefully this video has explained the market phases to you. They're your guiding star as a trader, and it's crucial to understand what phase you are in to decide what type of position is best suited to the market environment. And identifying what phase we are in is the first step in identifying a trending or mean reversion market, which we'll get into in another video. If you guys have any further questions or need support, don't hesitate to reach out via our social media, especially in our Telegram group chat, where an admin will get back to you as soon as they can. If you have questions, it always helps us build up, and because many other people will probably have the same question as you, so it's good that we get the feedback. So thank you guys for watching, and stay safe.